Have you ever looked at a stock and thought, is this cheap or is this expensive? Everyone throws around the term PE ratio, but almost nobody actually knows how to use it properly. And there's an even more powerful cousin of the PE that most retailer investors completely ignore. It's called the PEG. Today I'm going to break down these three things every investor in the stock market needs to understand. The first one is what the PE ratio actually tells you. The second one is why PEG is a more smarter and honest number. And the third one is how to read an entire sector, not just one stock. And all of this is going to be done using completely free tools. And I'm not just going to explain the theory. I'll pull up Reliance Industries on Screener Live and then we'll zoom out to a full sector view as well. So you can literally follow along on your own screen. So let's dive in. Okay, so this right here is the screener website. And so let's start with the PE ratio, which is known as the price to earnings. The formula for this is actually quite simple, and it's just the current share price divided by the earnings per share, which is known as EPS. So, in plain English, it basically tells you how many rupees an investor is paying today for every $1 that the company earns in a year. So if you look here at the screener, you can see the stock PE, which is 23.0. So depending on when you're watching this, that number does move daily because the share price also moves daily. So always trust the number on your screen over anything you hear, including this video. So now here's the important part. A PE number by itself means almost nothing. A PE of 23 isn't automatically expensive, and a PE of 8 is not automatically cheap. It always means something in comparison to the company's own historical PYE. So Screener shows this in the peer comparison section, which is right here. And you can basically compare distinct PE ratios. So if Reliance has historically traded between 18x and 25x over the last 5 years, and it's currently at the lower end, that tells you that the market isn't pricing in much extra optimism right now. And the industry average PE, refining and oil to chemical companies in India as a sector tend to trade in the low 20s range. So Reliance sitting close to that tells you how it's roughly in line with its peers, not widely overvalued or undervalued. However, this is extremely important and the trap that most beginners fall into. They see a low PE ratio and think undervalued and buy it. But a low PE can also mean that the market expects earnings to fall, maybe due to slowing growth, regulatory risk, or a cyclical downturn. A high PE can mean investors expect a strong future growth, or it can also mean that the stock is simply overhyped. PE tells you what the market is paying. It does not tell you that the exact gap that the PEG ratio actually fills. So now that this is done, I'm going to be talking about the PEG ratio, which is actually extremely essential to completely analyze a stock. And the PE ratio and the PEG ratio are both needed to actually select the right stock for you. So as you can see, if I again pull up Reliance Industries, you can see that the PE ratio shows right here. So basically the formula for PEG is the PE ratio itself divided by the earnings growth rate. So right here it's going to be 1.6, which is 23 divided by 13%. So PEG takes the PE number and asks one extra crucial question. Okay, but how fast is this company actually growing in profits? A stock may look expensive on PE alone, but can actually be cheap when you account for how fast it's compounding its earnings, and vice versa as well. So let's do the actual math using Reliance numbers on the screen. So if you go down to the profit and loss section, you can see the 5 year EBITDA or profit growth rate. So let's say Reliance's PE is around 23x, which you can see right here, and its 5 years earning rate is approximately 14%. So if you plug that in, the PEG is actually 23 divided by 14, which is approximately 1.6. Now, how do you read that number? The rule of thumb, first popularized by investor Peter Lynch. PEG is around 1.2. The stock valuation is roughly matched to its growth and it's fairly priced. If the PEG ratio is below 1.2, the market may be underpricing the company's growth, and it may be potentially undervalued. Now, if the peg is above 1.0, especially above 2.0, you're paying a premium growth for something that isn't maybe not materialized or is potentially undervalued. So a peg of around 1.6 for Reliance tells us a more nuanced story than the PE ratio alone. The market isn't pricing it as a screaming bargain, but it isn't widely overheated either. It's paying a moderate premium relative to its growth rate. That's a much more honest read than the PE ratio actually gives you on its own. So now I'm going to be talking about one more analysis method, which is the sector analysis. So this is extremely crucial to actually analyze a stock, not just by the stock itself, but the entire sector. So anything in a particular sector may tell you how much that particular stock is going to grow or decline. So now I'm going to be pulling up another website and I'm going to be talking about the sector analysis. Okay, so now we are in the stock market sector analysis website, and basically, this is the sector heat map. So, every sector that is color coded green to red, showing how much money moved in or out today. This week's toggle between day, week, and month and year to see whether a sector's strength is a 1 day blip or a real multi month trend. So, a trend line aggregates the average P/E ratio and growth metrics across every single stock in a sector, not just one company. So instead of asking, is Reliance expensive? You can ask, is the entire oil and gas sector expensive compared to IT, banking, or pharmaceutical industries? So the sector scores. A composite score blending valuation, momentum, and analyst sentiment, which gives you a quick shorthand for which sectors institutional money is currently favoring. So this matters significantly because a stock picking inside a weak sector is swimming against the current, whether the PE ratio and PEG ratio are good or not. So this is a major problem, and it is extremely essential to actually pick out a sector before you look at the other two ratios. So as right here you can see different sectors. So if you look at fertilizers, it is going at a loss of negative 1.78%, or retailing is going at a loss of negative 1.49%. So basically, food and beverages and tobacco is rising at a rate of 0.22%. So another thing that is extremely essential when picking out a sector is how it's actually doing in the market, not just the statistics. So let's pick out a random sector such as healthcare. So if you look at the data that is there in India, here is the data of 2025, where roughly 22 to 23 lakh individuals appeared for the NEET UG exam, the single entrance exam test that decides the future for all of these students. Out of those, 12.3 lakh candidates qualified by clearing the cutoff, but India has only around 1.15 to 1.3 lakh MBBS seats across the entire country. Do the math. That means even among students who qualify, roughly among 1 by 10 actually secures an MBBS seat. Less than 5% of the total aspirants get a government seat. Now, flip that lens outward. Globally, there's a severe shortage of doctors. The WHO, who has repeatedly flagged a worldwide healthcare workforce gap, and countries like the US, UK, Germany, and Gulf nations actively recruit Indian trained doctors and nurses. So, you have a system with massive constrained domestic supply and a strong domestic plus international demand. So, why does this matter? Well, if you look at the Indian seats, it's significantly less than its actual population. This means that the demand is much more and it's technically bound to rise in India. This means that healthcare is going to be a great sector. Now, um, along with this, if you look at technology, it's currently going in a major loss, and this is most prominently because of certain artificial intelligence, due to which the job opportunities are significantly decreasing. Okay, so everything that you learned right now, that's pretty much it. That's all you need to analyze and a stock like the professionals do. So now let's just bring it all together. Today you learned that the PE ratio tells you what the market is paying for a rupee of current earnings, but it's meaningless without comparing it to history and peers. So PEG adds a growth into the equation, giving you a more honest read on whether that price is actually feasible and justified. The sector analysis zooms on an actual sector, which is extremely crucial to pick out a stock, because if a sector is about to decline, then the PE ratio and PEG ratio is not going to mean any value to you. And structural stories like India's medical seat storage or technicalities are exactly what long-term sector trends are ultimately built on. So now none of these tools actually tell you what to buy, but what they give you is a framework to ask better questions before you put your money anywhere. So now go open screener, pull up a stock you already own, and run through this exact process: PE, then PEG, then pure table, then a full sector view on trend line. If this helped, hit subscribe. I'm breaking down one investing concept like this every week. See you in the next one. Thank you so much. Bye.